Hi there, it's Dymphna here with my weekly Intelligent Property Investor of the Week update. Glad to be here with everybody. We are going to cover off on a lot of information today. There's been a lot of data out. But first of all, let me explain why I'm doing these updates with all of you. First of all, I want to make sure that you are a smarter investor, because smarter investors make better decisions, and better decisions give you better results. And that's what my aim is with all of these updates, is to keep you informed so that you can make better decisions and ultimately get better results, because that's what it's all about. It's about creating better results, because we're coming into a period of time, and I'll explain to you why that is as we go through all of these updates. That is going to make or break you. The next few years are going to be very, very crucial to your livelihood, really, for the rest of your life. You know, the next 3 to 5 years really could set you up for the rest of your life. And that's why these updates are going to be so important to you as we go through. Now, I'm doing a whole series of them. So if this is your first time with me, then welcome. And make sure that you go back and have a bit of a listen to all of the previous ones that I've done as well, because it's one builds upon the other, and each one we've got the most recent data coming out all the time. So there's a lot of hype in the media and other things about where the market's going, and fear around COVID and the vaccine and all of these sorts of things. Well, I want to lay a lot of that to rest, because when we get down to the bottom line economics, then it really starts to make a whole lot of sense. Now, look, if you're listening to this on a podcast, you're going to get a much better experience if you come across to my website. Now, I blast this out all over the place, so it goes onto podcasts, it goes onto Spotify, iTunes, it goes onto my YouTube channel, and of course it goes up on my website. So obviously on YouTube and on my website you can see all of my charts. Now, I think the charts are going to be very, very important as you start to understand what's actually going on. I'll try and describe them as best I can, but the best thing to do is to jump onto my website, which is iloverealestate.tv, and subscribe to my weekly updates here, the Intelligent Investor Masterclasses. Because that way you'll get notified that they're coming up, they're out there available to you. You won't miss any, because as things happen, good or bad, I'm going to be sharing them with you. So that's my little bit of an introduction to where we're at the moment. Let's get into the masterclass. So as we have a look at what we're going to cover today, as I said, there have been quite a bit of information coming out during the week, and the biggest lot of information to come out has actually been the jobs data. So jobs data we're going to cover. I also want to cover the easy money stuff. Now, easy money, particularly American style, what's happening in there? Because America's kind of representing what's happening in all of the Western markets right now. So it's good to be able to see where they're at. And of course, I'm going to come back to Australia and what that all means. And I'm going to finish it off with a truth bomb of the week, which is that money can't buy you happiness, but it can buy you a lot of answers. All right, so let's start with jobs. Where are we at on a jobs front? Well, before I get into the actual data, I thought what I would do is go through what jobs actually mean for the economy. You know, what does it mean if we create a new job? What does it mean if unemployment comes down? And I think that's pretty important. So let's have a look at the chart over here. Now, excuse me, in this chart, more jobs creates higher disposable income, which then increases demand for local services. So whether that's a service-based industry, like, insurance or high tech or education, any of those things, it has a multiplier effect, and it creates more jobs in the local community, such as the cafes, the banks, the bakeries, the post offices, the barbers, everything else that you see there. But so too does manufacturing. Now, manufacturing creates that same kind of multiplier, and again, it plays across into the industry. The higher the technology, the higher the pay rate of the service or good being supplied, the more impact it has in the larger community. And that's really what I'm trying to represent here. Service multipliers, where we're talking about higher technology, creates more impact in local services and creates more jobs than lower paid jobs being created, like those in manufacturing and in the the lower paid industries right across the board. I mean, I've used manufacturing as one of those, but there are a lot of them. So before we get there, before we explain what that actually means from actual job numbers, I also want to look at productivity. Now, in the last 70 odd years, we've increased dramatically from a productivity perspective. You can see there, I've got the old typewriter back in the 50s, and now we've got, computers and, we've got watches on our arms that we can talk to and make phone calls on. We've got, all of the smart technology, etc. And it's getting, the increase in that is getting more and more rapid with artificial technology and all of those sort of things. But the productivity in the local services hasn't really grown a lot. In the last 50 odd years, we still drink the same amount of beer. We still eat pretty much the same kind of stuff. We, in that local community, we still go to the grocers. We still do all of the normal things. So our expenditure from our money hasn't gone up as much from a productivity perspective as our technology has. Now, that's creating another compound effect, because when we export our technology growth, so, our education, our high tech, our service-based industries, anything of a higher technology level, it actually brings in more money and creates even higher demand for local services. So let's have a look at that little bit of a gap and what that gap actually means from a jobs perspective. So here we have when we create 10 new jobs of a baseline level, it creates another 11 jobs in the local services industries. So basically, it's a 1 for 1 and a bit. For every job that we create, like a nurse or a fireman or a I don't know, pick your industry, basically. Someone who grooms the golf courses or works in a manufacturing plant or any of those sort of things. We're basically creating another job out there for the, for the grocer or the barber or the pizza delivery guy or whatever else. We're creating at least 1 for 1 and slightly over 1 for 1. So 10 to 11 is what the figures are actually showing. But when we create a higher paying job, like a high tech job of some description, we don't only create 1 for 1. In fact, the figures show for every 10 that we are creating, it actually creates another 17 new jobs in local services. So that's pretty dramatic, isn't it? It's pretty dramatic that is the compounding effect. So what does that tell us? It tells us that all jobs are good. They have a double whammy effect, but the higher paid jobs, the higher service industry jobs are the ones that actually have the biggest impact on our economy, particularly when we're exporting those services. So let's have a look at the latest figures. So the latest figures show us, where are we? There we go. No, for whatever reason, that one there's frozen. Let me just fix that for you. The latest figures show us that Indeed is one of the big reporters on property, and it shows us there that we are 32.9, so you may as well call it 33% higher than we were pre-COVID from a jobs perspective. So we are advertising more jobs now than we did have pre-COVID. When we look at the next one here, you can see that this really shows us that the job advertising has been ramped up. And this little dip that we saw here, that was all about COVID, obviously, and it came right down. But look where we are. We're back up to pre-COVID levels from job ads. This is a different media that's actually been reporting on this. So it's a different organisation. It's IVI, Job Advertising. But it actually shows how it's been slowly increasing over that period of time, which is all a great thing. This again shows you that the unemployment rate has been coming down. So, I mean, I'm probably older than most of you that are listening to this, and I remember when jobs way back in the 90s and the 80s and things like that, where we had unemployment up close to 10%. And you look, it was tough. The early 90s, when we had that last recession that we actually had, things were really tough. And the unemployment did nearly reach to that 10%. And when we went into COVID and we spiked up here at over 7%, there were a lot of economists that were saying that the unemployment rate was going to go up somewhere around the 15% mark. And this was going to be the worst recession since the Great Depression. Well, it's turned out to be a blip in the ocean, which is exactly what I was telling you guys last year. So you can see how quickly the unemployment rates come down. In actual fact, we've beaten the 6 mark. We're actually now down to about 5.8%, which is very manageable. I mean, we've sat most of the 2000s in around about that kind of level. So we're back down to really normal levels. Just going again, you can see here, this is the total employment, and you can see we are already back up to pre-COVID levels, and it didn't take long to get there. And the other important thing is when we start looking at part-time jobs compared to full-time jobs. I mean, part-time jobs, which is the red one here, they rebounded very quickly. And a lot of people going, okay, we'll put you back on part-time, but we don't know where the market's going, all of this kind of stuff. But then we got into the full-time jobs, and there's a lot more confidence in the business sector right now. And that's why we're seeing the full-time jobs back. And we're already back in a full-time basis and part-time basis back to where we were pre-COVID. So what does all this mean? Look, it means that we've got great news for the Australian economy. Jobs growth has a compounding effect. And remember, as I say, that the scaremongering that was going on pre-COVID was very much about the fact that we were going to hit 10%, 15%, some were even saying 20%, which, when you looked at the underlying fundamentals, which is what I bring to you now on a weekly basis, you'll understand that that simply couldn't happen. And that was my message all last year. It's my message to you now, and I want you to really take heed of some of the stuff that we're talking about. So the next thing that I want to go on to here is America. Now, America, I'm showcasing America because it is representative of what's going on in the Western world. The figures are very easy to pull out for America, but the same thing is happening in England, in a lot of the European countries, in Canada, New Zealand, Australia. You know, these same trends are playing out in our economies. So what's the first trend that's happening here? Well, the first thing is that the US sales, so this is the median house price for sales of property in America. Now, look, we're up 15.8% on a year-on-year basis. Now, take into account that Australia is very property-centric. So our property market moves very, very quickly. It responds to the economy more quickly. Our go-to asset is the property market. It's not actually the share market like it is in America. So for these figures to be so strong in America, where it's not the flavour of the month, stocks and shares are, it even amplifies what's actually going on in some other countries where property is the go-to asset. So dramatic increases there in pricing as we're seeing in the States. This one shows you the home builder optimism. So this is the big spike that we're seeing for new homes being created in America. The same thing's happening here. On our score, we've actually got a double whammy there because we've had the builders boost. So everyone was jumping in to try and get the builders boost. But new homes are certainly on the rise. Now, what we're seeing here is the difference here between the home builder index, which is the purpley coloured one, and the blue one here being the S&P 500 index, which is their share market. And you can see here that it's the homes that are actually, even in the States, outperforming the stock market. So, does this mean that they're going to go into oversupply quickly because they're building all of these new homes? And the answer to that is definitely no. Because look at this chart here. This chart here actually shows the undersupply in housing in the States. Now, I've been talking for a long time about the Australian housing market and how undersupplied it is. Well, the same story is playing out in the States as well as in the UK. And it's going to take quite a considerable amount of time before that reverses back and comes back into any kind of equilibrium, let alone into oversupply, which is where we would look at a normal correction. So then we have the housing inventory. Now, this is the biggest problem across the world, but particularly the Western world. Because of COVID and people becoming more insular and a little bit more safety conscious, they're hanging on to things a lot more. So they're hanging on to their homes. Now, you can see here, this is the reduction in listings. Look where we are down here compared to, to where we've been in the past. So look, this was 2017, you got 2018, 2019, 2020 obviously took a massive dive. But look where we are so far here in 2021. People are not listing their properties for sale. And this is creating a massive spike in pricing because we are so undersupplied. There is so much pent-up demand and nobody's selling. Go to the extreme. Well, some people are obviously, but the limited stock. I mean, if you talk to any real estate agent anywhere in the country, pretty much, you ask them, okay, how are things going? So, I wish I could get some stock to sell. I could sell everything that I list. So it's listings that are the issue, and this chart really amplifies this because this shows the slump that we had through COVID, where we weren't building any homes. Now, this is an American chart, but Australia was very, very similar. So there was this massive, massive slump. Now, this is in the number of households. So what that meant was that we had a lot of teenagers that moved back into home to save money. We had people who were going into share housing to try and save money. So everybody just went into this contraction, and the number of actual houses available contracted as well. So there's a long time between all of these houses going out and getting built and whatever before we recoup from this massive pent-up demand that was created here through 2020. Now, add to that what we had in Australia. We not only had this slump through COVID, but we had the big slump and huge pent-up demand from the end of 17 to the beginning of, the middle of 19, where we had all of this pent-up demand and it wasn't being satisfied because of our regulations in the finance industry. So APRA got in, squashed the banks so no one could get a loan. So we've got all this massive pent-up demand, and then we had the COVID pent-up demand. Our figures are actually even more dramatic than these ones here in the States. What this chart here shows is the mortgage orientation by credit score. So what we're seeing is those who are in the wealthier sector are taking massive advantage out of their good credit score and being able to get out there and start investing. So there's massive traction in the market. Easy money, American style. Like all the other Western countries, America has been out there turning on the printing presses, printing money. So this chart here shows you in the last little bit here, 2020, just how much money is actually being printed. So, you know, the money printing tap has been massively turned on. And remember, in all of my other talks that I give you and updates, we've been talking about every time, not just once, not just occasionally, but every single time that we have printed money in any country, the end result is that the stock market goes up and the property market goes up. And that's what's playing out right now. You look at the banking system. I mean, the reserves from a banking perspective, there is so much money sloshing around. Banking deposits, so much money sloshing around. And all of that is playing out in the market. What we're seeing is that is all playing through into the market, into the housing market and also the share market, but mostly the housing market. Now, the states recently had a stimulus package released. This is where it all went. 410 billion went into just straight out money to the people, stimulus checks going out to everybody, bit into the government, extending employment programs, tax credits, transport, health, education, small business, agriculture. Everybody seemed to get a little bit of it. So there's lots and lots of indicators that are showing that the economy is rebounding, and it's rebounding quickly. So what I'd like to do now, before I go on with the rest of the masterclass, is to actually have a chat to you about how I can help you with this. So if you're enjoying the type of information that I'm putting out right now, I'd like to just take a couple of minutes before I talk about Australian property market and let you know how I can actually help you. So what I'm going to offer you guys is on a limited basis, because I've only got limited advisors, but I'm offering you the opportunity to actually have a 60-minute sit-down appointment with my advisors. Now, what they're going to do is to help you as to where you're at and where you need to go. Let me just put on a different screen here. So they're going to have a chat to you about your goals, your dreams, your aspirations, and what you want to achieve. Because myself and my team really recognize that these next few years are going to be very, very crucial to you. So you really need to be stepping up. You need to be maximizing your circumstances over these next few years. Because think about it, in somewhere around 3 to 5 years, you could have your income replaced. You could be debt-free on your mortgage. You could be in a situation where you never have to work again a day in your life if you don't want to. Not that that's the end game, but it's about being in a position where you are comfortable. So if anything should happen in the market or anywhere else, you're safe. And if there's anything that COVID has taught us is we need to be safe. We need to have buffers. We need to have a passive income that if our job goes tomorrow, it doesn't matter. We're safe. We've got everything sorted. So in that 60-minute, advisory call, I'm calling it the I Love Real Estate Breakthrough Session. I thought that was a great title. They're going to talk to you about where you're at, where you want to go, and perhaps some of the things that you can do to actually accelerate your circumstances, how we can help you in that. And you can make a very clear decision then, and an informed decision, intelligent decision about your future, and what it really looks like for you, and what it means for you. So there's only a handful of them there. I don't have unlimited advisors. All the details are here. You can click on make an appointment with one of my advisors, and let's get you sorted. Let's get you on a path to replace that income and start to build a sizable wealth portfolio. Because what's happening in the market right now is extreme. And if you miss this period of time, you're going to be waiting a very, very long time before you're going to see this kind of opportunity again. Fortunes are going to be made in the next few years. but you need to be ready for it, and you want to be informed. You don't want to be buying the wrong kind of property. There's a whole lot of crap out there that I see slushing around the market that if you buy that sort of thing, you're going to be held back. You're going to be jeopardizing the opportunity that's actually there for you. And that's why we want to come and help you guys. So take up my offer there to have a coaching call. It's going to be 60 minutes. The advisors can help you about where you're at, where you want to go, and what action you can actually take to get there. So hope you take me up on one of my advisors' appointments there for the breakthrough, I Love Real Estate breakthrough session. Let's get back to the masterclass. All right, so the next thing that I want to talk about now, of course, is Australia. Where are we at from an Australian perspective? And particularly from a housing market perspective, because the housing market, as I say, in Australia, we are housing mad. So our first go-to asset is actually property. It's not stocks and shares like it is in America. It's property. So let's have a look at that. All right. This chart here shows the relativity of 5 capital cities. I've just picked out 5 here, and what it's done since COVID. I'll just put it on the big screen so you can see it a bit better. So you can see there back as a starting point of January 2020, the market went up until we hit COVID, and then they all started to fall in some form. Adelaide was actually one of the strongest. Brisbane didn't fade away too much either. Melbourne probably, the blue one there was the one that faded away the most. Perth did pretty well. Sydney obviously did well, but look where they all are now. So even Melbourne is back to where it was pre-COVID, March last year, basically. All the others are dramatically above. So, that's the kind of thing that is playing out right around the world. That's the kind of thing that is, you need to be on top of. Is it going to last? Look, we've got so much pent-up demand and undersupply, it's going to take a number of years before we actually catch up to what's going on. Now, this is just internally. If we then add, when we open the borders, when we are able to travel again, when we start accepting migration, that will just add a double whammy to the whole thing, and we are going to have another surge that comes on after that. Sitting around and waiting is not going to be the right thing for you to do. So what's the problem? Well, the problem is exactly the same problem that we had with America, and that is the lack of listings. We simply don't have enough listings. So, we've got massive demand and pent-up demand from 2017 and then COVID, and now we can't get listings because everybody's sitting on their stock and they're sitting back riding the wave. They're sitting back there just getting returns on their property while it sits there and does nothing. So that's the biggest thing that is our problem right now. Now, one of the precursors to more price increase is clearance rates at auctions. Look where we're at here from a clearance rate perspective. You can see here, that's COVID coming down. Clearance rates were pretty low. We are now higher than we have been in the last 10 years from a clearance rate perspective. The last time we were at these similar levels was back here in 2015. Now, that was, you saw the rise that happened through all of that and the 16s and 17s and what, the massive ramp up and increase in pricing that happened through those years. That's what we're coming into right now. Now, this is the precursor of pricing having more upward pressure. This chart shows, I'll put it on the big screen for you. This chart here shows that the percentage increase in pricing that we've had over the last 12 months, as I said, we've gone through. So it's sorry, this is the listings, beg your pardon. This is the number of listings that are available for sale. So you can see there that we're massively down across the board on what we would normally have available for sale. You add that to this chart here, which shows that demand is still very, very high, and in fact is higher than it has been for months and months and months. Demand is right across the board is incredibly high. And I did show this a couple of weeks ago. I talked about rental demand. It's also high. And when you've got rental demand combined with lack of stock, the two together give you a massive upward pressure on pricing because the yield is high. You're actually going to have people jumping assets from stocks and shares and other things into property to actually get the higher yield. And this is the percentage change in rental rates. So you can see there that our rental returns just, in the last 12 months are up 3.2%. So yields are going up as well. Now let's move on to money. And money is exceptionally cheap right now. And, it's reasonably available as well. So, this chart here shows you how the interest rates have been coming down right across the board with the 3-year fixed and other things. I'll leave it on the big screen because there's a lot of figures in there. But just look at this chart on the right-hand side. The tealy coloured one there at the top, that's the investors of existing loans. So, this is refinancing existing loans down to lower levels. The dark blue one is investors with new loans. And again, those loans have been coming down from an interest rate perspective. The yellow one is owner-occupier of existing loans, and the red one is for new loans for owner-occupier. So you can see, a massive decrease in the interest rate that we're paying. Money is cheap. We have not had this level of cheap money for decades. Not 40 years. Ever in Australia have we ever had interest rates as low as they are right now. And that's being played out across the banks. I mean, this particular one happens to be the CBA with new lending, and you can see there with the smoothed out, that's what it's doing. That's what COVID did, but look where it's heading now with new lending. A massive increase that, there's more and more loans becoming available. With the easing that happened in the last October budget and the legislation around that to ease the lending criteria for banks, after smashing them over the head back in 2017, we're starting to see that play out in the market right now. Some of the delays that we're seeing are still from offshore processing, and they're trying to catch up on that. So the sheer volume of loans that is going through is creating a bottleneck for timing. So if you're signing any contracts or anything like that, make sure you've got a nice long finance clause if you're anywhere by New South Wales, because they've got the exchange process, because it just takes longer to get those loans through. They've got such big backlog right now. This just shows you the difference between the investor loans being the red one and the owner-occupier. Bit more of a spike in the owner-occupier due to the home builder grant that we've had. That's now finished now, but we're seeing here, even the investor loans are well up there as well. So a little bit of a quick recap. First of all, the finishing of JobKeeper has had very little effect on the unemployment rate, simply because there is so much confidence in the business sector, particularly if you get out of things like retail and hospitality and things like that, a little bit of travel. Take them aside, the confidence is actually exceptionally strong. The US housing markets have had a massive resurgence, and that's being played out across all of the Western countries. Australian housing market is performing as I predicted all through last year. So as I predicted all through last year, it's all playing out now. I was actually reviewing a home study program that I put together 3 years ago. It was called Next 10. So that was back in 2018, way before any of this was even conceptualised. I talked about the next 10 years and how innovation was going to change the way we do housing and work from home and remote living and all of this kind of stuff. Well, COVID has actually exacerbated that. So everything that I was talking about in that Next 10 home study program is now playing out real time as we speak. So I don't think I'm psychic, or maybe I am, but it was all about the fundamentals and how the market was actually moving at the time. What COVID has done, it's accelerated all of those trends that I spoke about back then. So what's the truth bomb of the week? Money can't buy you happiness, but it can buy you answers. Why am I talking about this? Well, I'm talking about this because there was a recent study that came out, and I'll put this up on the big screen so that you can see it. So there were three major studies that were done, and they looked at how happiness was measured. So over on the left-hand side, this is what we think makes us happy. It's things like buying things, having a successful job. It's about, personal accomplishments and things like that. The one at the top on the right-hand side is what really makes us happy. And that's about gratitude, living a life of gratitude, buying experiences rather than buying things. So things like travel and experiences with the family and those sort of things. Giving money away, supportive network, and the expectation of good health. And then down the bottom is the UN's measure of happiness. So their perception is, their view of happiness, their measure of happiness is the perception of freedom, freedom from corruption. Now, when you overlay all of those and what they actually mean, the big one in the middle that is part of all of them is having lots of money. Having lots of money can certainly buy you the ability to be able to do the other things, like give money away, supportive network, the expectation of good health. You can buy good health, to a large extent. You can buy better health. You can buy better other things. You can have more experiences. You can be more grateful for the position that you're actually in. Freedom in this country is pretty much a given, and freedom from corruption, well, we're pretty much there, aren't we? So that was my little truth bomb for the week. I hope you enjoyed that. Now, don't forget to book one of those 60-minute real estate breakthrough sessions with one of my advisors. They are free. There is no cost for them. And see what you can do proactively to take advantage of all of the massive upswing that we're seeing in the market right now. This is the biggest upswing we've seen in decades. And I'm telling you, you don't want to miss it. So for anyone who's listening to me rather than seeing me with all of my slides and everything else, the place to go to get one of those appointments is iloverealestate.tv/questions/. So jump on there, get one of those free 60-minute advisory breakthrough sessions, and let's break through and start to get some serious traction in the market that we are in right now. So that's it for me this week. I hope you enjoyed my Intelligent Property Investor Series. I encourage you to go across to my website, iloverealestate.tv, subscribe to my updates, so that way you're going to get these coming out to you every single week. So you're always on top of the latest information, and you know when things pivot. Because when things pivot, I'm going to be just as active telling you what to do then as well. So jump on board, be part of the Intelligent Investor Masterclass series, and let's make some better decisions, which make give you better information, gives you better decisions, which gives you better results. I'll catch you next week. Bye now.